Have you ever wondered how some people grow wealth by investing in stocks while others lose money and give up? Stock investing can feel overwhelming, filled with confusing charts, numbers, and terms, but at its heart, it's about owning a piece of a company and watching it grow with time. When you understand the fundamentals, investing in stocks becomes one of the most accessible ways to build long-term wealth. Welcome to HowExpert Tip of the Day, where we bring you real-world tips from our how-to guides on all topics from A to Z. If you want to learn even more in-depth strategies, examples, and techniques on this topic, check out HowExpert Guide to Stock Investing, available at Amazon, Audible, Barnes& Noble, Google, Kobo, Apple, Spotify, and all major bookstores as an ebook, paperback, hardback, and audiobook. At its core, stock investing means buying shares, small pieces, of a company. When that company grows and earns profits, shareholders benefit through rising stock prices or dividends. Stocks are more than just numbers scrolling across a ticker. They represent ownership, opportunity, and participation in the global economy. Today, let's explore the key principles you need to understand to invest wisely and confidently. First, let's talk about the power of ownership and growth. When you buy stock in a company, you're not just betting on numbers, you're becoming a part owner. If that company expands, earns profits, and innovates, the value of your shares often rises. For example, early investors in companies like Apple or Amazon saw enormous gains as those businesses transformed industries. The lesson here is that stocks let you participate in business growth without needing to run the business yourself. Second, consider the difference between short-term noise and long-term growth. Stock markets fluctuate daily, often driven by news, rumors, or emotion. But over decades, markets have historically trended upward, rewarding patient investors. Someone who panics and sells during a downturn locks in losses, while someone who holds quality stocks often recovers and prospers. The key takeaway? Focus on the long-term horizon, not short-term volatility. Third, let's examine diversification. Putting all your money into one stock is risky. If that company struggles, so do you. Diversifying across industries, countries, and sectors reduces risk while giving you exposure to multiple growth opportunities. Imagine balancing tech stocks with healthcare, consumer goods, and energy. This way, if one area dips, others can balance it out. Diversification isn't about avoiding risk entirely, it's about managing it intelligently. Fourth, we need to talk about risk and reward. Higher potential returns often come with higher risk. A small startup stock may skyrocket or crash, while established blue-chip companies offer steadier, more reliable growth. Understanding your own risk tolerance is critical. A college student saving for retirement may take on more risk, while someone close to retirement may prefer stability. Matching your investments to your personal situation creates peace of mind and better results. Fifth, consider the role of research and fundamentals. Successful investors don't pick stocks at random. They study company earnings, leadership, industry trends, and competitive advantages. Looking at metrics like earnings per share, price-to-earnings ratios, or dividend yields provides insight into a company's health. For instance, Warren Buffett famously invests in businesses he understands deeply, focusing on strong fundamentals rather than speculation. Knowledge is your shield in the stock market. Sixth, let's discuss different strategies. Investors can focus on growth stocks, companies reinvesting profits to expand quickly, or value stocks, companies trading below their intrinsic worth. Some prioritize dividend stocks that provide steady income, while others invest through index funds that track the broader market. Each strategy has its place, and the best approach often combines multiple styles depending on goals and personality. Seventh, think about discipline and consistency. The most successful investors aren't those who chase quick wins. They're the ones who invest regularly, stay disciplined, and let time work in their favor. Investing $200 a month consistently over decades can grow into hundreds of thousands of dollars thanks to compound interest. The message here is simple. Consistency beats timing the market. To tie these ideas together, picture someone who sets up a diversified portfolio, invests steadily, and tunes out short-term noise. Over time, their money grows alongside the businesses they support, creating financial security and freedom. Stock investing isn't about luck, it's about patience, knowledge, and discipline. When we summarize, stock investing means understanding ownership, focusing on the long term, diversifying your portfolio, balancing risk and reward, researching companies, exploring strategies, and staying disciplined. With these principles, anyone can use stocks as a tool for building wealth and achieving financial goals. Here's a thought to remember: the stock market rewards patience. The earlier you start and the longer you stay, the more powerful your money becomes. For even more tips, techniques, and practical examples on this topic, check out HowExpert Guide to Stock Investing, available at Amazon, Audible, Barnes & Noble, Google, Kobo, Apple, Spotify, and all major bookstores as an ebook, paperback, hardback, and audiobook. HowExpert publishes how-to guides on all topics from A to Z. Visit howexpert.com to learn more.